from Nationwide, their chief economist, and of course, an important career at the Fed as well. Paul, good noon to you.
Nice to see you, Tom. How are you?
Very good. Bring up the consumption chart right away. I want to bring it up, if you would. This is one of the backstories of the week, which is we're always looking for the American consumer to get things done. We're up at 70%, 69% of GDP. Are we going to consume less in the future, Dr. Ballew?
Absolutely. We're in an environment right now where households are going to go through a period of time and they have to rebalance and get their household finances in order. They'll come out every now and then if we incentivize them, as we saw in the third quarter, especially in the vehicle industry, my old industry. We saw a bounce back, but it's pretty temporary. Then we pull back. We have to save a bit more. So I would expect real consumer spending to be in that 2 to 2.5% range going forward. And if that's the case, then GDP growth is going to be sub 3%.
What does the Gloom crew get most wrong? We see Bruce Kasman and his team go 1% to 2.5%. You have been, I'm going to call, resiliently optimistic, like Brian Westbury. It must be the air out in Chicago. But what does the Gloom crew get wrong?
Well, it always helps to be in the Midwest, I guess.
Yes.
In the
Seriously.
Midwest. But
no, stop. That's important. You're in the Midwest, you're not in Manhattan, and that makes a big difference, doesn't it?
Well, I think it's important from maybe our perspective that we're looking at the real economy and the fundamentals. We never thought that this recovery would be anything other than unusual. It would be choppy, uneven, volatile. But we did see the fact that the healing process is making some progress. And while we get caught up in the day-to-day headlines of the Eurozone, or we get the dynamics of budgets and the Congress and what's going on in Washington, we are seeing a household pullback on debt. We are seeing businesses be in terrific shape in terms of corporate profits and balance sheets. And those are factors that we can't ignore, Tom. And I think importantly, finding that balanced view, maybe it helps to be in the Midwest. But we've looked at it all along as being a recovery that would be 2.5% choppy, right, volatile. But we really didn't see it at risk in the second half of this year.
A financial economic question, a critical question, and I don't expect you to give me information on Nationwide's matching of liabilities in their pension portfolios, but everything's a jumble. The Fed has moved interest rates, and we brought the 30-year and the 10-year down, and yet we have actuarial responsibilities out many, many years. How is the big money, or how are our viewers going to meet their obligations if the Fed crushes us with low interest rates?
Well, it's the biggest issue out there, and I think it's the most underreported topic that we have right now, and that is our future unfunded obligations and the future commitments we have, whether that's in private sector pension plans, which are at historically low levels in terms of their funding levels, whether that's in the state and local area where we're also struggling to meet those future obligations, or individually. The real answer to the question is we're probably going to have to save at much higher rates than what we even assumed a couple of years ago, when we were assuming savings rates would have to double to put us in a position to meet our future obligations. So a big, big challenge, the number one issue we're focused on. I would also point out, Tom, this is part of the unintended consequences of QE 1 and 2 and Operation Twist. And we have to think about those unintended consequences as we're trying to prop up the recovery and trying to help housing and other sectors. Right. There are costs associated with it.
This is a critically important thing. Let's rip up the script right now. Forget about the other elements, folks. Paul, when you look at your statement that we got to put more money aside, what you're saying is nominal GDP and the stock market is not going to ride to the rescue. Do I understand that correctly?
Absolutely. What's going to ride to the rescue is time, and we allow ourselves to heal and save and get our balance sheets back in order, and then also hopefully good policy actions that encourage the right behavior. You know, the bottom line we face, whether we like it or not, is we misinvested, we overconsumed, we didn't save adequately for the span of a decade. Look at household debt. It went up threefold between 1999 and 2006. Just a staggering amount to even think about that we now have to readjust to. So let's facilitate that healing process. Let's encourage the right behavior. And then as we get beyond this window of the next couple of years, we'll position ourselves for stronger growth.
I want to bring up Alan Meltzer here. That's not it, folks. You got the wrong one there. Let's bring up Alan Meltzer in the Wall Street Journal today. There it is. 4 reasons Keynesians keep getting it wrong. Meltzer of Carnegie Mellon, now that the Keynesian euphoria has again faded, perhaps the administration more likely the next will recognize the reasons for the failure and stop asking for more of the same. Paul, I don't need you to give us a political opinion here, but what form of stimulus is good stimulus?
Well, I think right now the most important stimulus would be do no harm, and that is don't inject more uncertainty into the marketplace like we saw during the summer. So hopefully we'll get a budget accord, a credible plan to address entitlements as well as the tax code long term. That's a great stimulus to build confidence in the marketplace and put some certainty back in. Beyond that, it would be helpful to re-examine the costs we've added into this recovery process on the regulatory side. Doesn't mean we shouldn't regulate institutions. It doesn't mean we shouldn't try to correct some things. But we have to do it intelligently. And then last but not least, maybe some infrastructure spending warrants attention, not just because of the short-term lift, but there are long-term economic benefits with infrastructure that if it's done correctly, we can reap.